It is over. U.S. bankruptcies are soaring, but it's not just USA getting smacked by bankruptcies these days. Economic conditions are worsening, and I want to discuss what the impact of all these bankruptcies is having and what it could mean for risk assets, whether that be our tech stocks or Bitcoin or whatever else. So let's get into this story. And of course, make sure to subscribe to the channel if you're not already, and leave a like on this video if you do appreciate this kind of content. So the Fed could still kill off more zombie companies even after bankruptcies have spiked by 54% last year. Keep this in mind. When the Federal Reserve started raising interest rates, one of their major goals of that situation was to cool things down in the economy. They needed to fight inflation, sure. So they raised interest rates. Now, how do you fight inflation? You help bring demand down a little bit. That means you have to lose your job. That means some companies need to close. Of course, you're going to lose your job because your company closed, because there's not enough people buying stuff because demand has fallen. And of course, those higher interest rates make it so that companies that have taken on debt are basically screwed because they can't service the debt anymore once it gets refinanced. So you lose your job, you lose your house, you get some fentanyl, you live under a bridge. It's a great vision that Jerome Powell has for America. Yikes. Yikes, man. I tell you, what are these guys doing to the economy? Sometimes it blows my freaking mind. I want to share this with you. This is a great chart here showing U.S. corporate bankruptcies in 2023 compared to previous years. Now, 2010 saw a lot of bankruptcies, 827 in total. Now, by the same time in 2010, we'd already had 530 bankruptcy filings compared to 402 bankruptcy filings this year. Now, that lines up with about how many we had in 2020 during the Mexican beer crisis. But I want to point out here that bankruptcies happen. Bankruptcies are normal, and bankruptcies are a pretty common part of the economic cycle because in lots of quote unquote good years, we still had plenty of bankruptcies. 2021, 408 bankruptcies for the whole year, 256 by this point in the year. 2018, great year for markets, 317 bankruptcies. 2017, 305 bankruptcies, so on and so forth. So high bankruptcy numbers happen every single year. So far, even though we have seen a big uptick in bankruptcies, so far, we're not actually that much out of line with previous years, although we could go as bad as 2010, for example, which was kind of a hangover year from the 2008 financial crisis. We could see numbers still go much higher for 2023 as these refinancing of debt burdens start to come forward here for different companies. So we could see more of that. Now, which industries are getting hit the hardest? Well, according to this chart, we have 48 companies from consumer discretionary spending. We have 45 from industrial, 39 from healthcare, 26 from financial, 14 energy, 14 consumer staples, 11 IT, 5 materials, and others are much, much smaller. So as you can see, consumer discretionary spending stuff is what's been hit the hardest because people are running out of money. As we've covered, we've seen bank deposits go from savings account deposits go from like 2 trillion down to 200 billion, a 90% decrease, with 100 billion of that being spent per month. U.S. credit card debt is up dramatically, topping $1 trillion, although as a percentage, that's actually not super high historically. We've seen higher total percentages of that in the past, but $1 trillion is still a pretty damn big number. You can thank, of course, inflation and currency debasement, all that stuff for numbers just getting bigger and seeming like they mean more, but they're not actually as big as they would have been in the past. The guys over at the Kweezy Letter pointing out August marked the busiest month of record for U.S. bankruptcy courts. That's according to Bloomberg. So August was a particularly bad month. And when you have a record month like that, you have to stop and take a moment to think, whoa, hey, let's put the brakes on here for a second. WTF is going on? Is this bad? Is this something to worry about? Well, to an extent, yes. As they point out, too, there are now $238 billion of corporate bonds and loans in the U.S. that are trading at distressed levels. So $238 billion of the corporate bonds and loans that may have trouble repaying them. Now, what happens when $250 billion of loans don't get repaid? The people who lent them that money also get into financial distress. And what happens when those companies get into distress? Well, they go bankrupt too. The guy who had the corporate bonds goes bankrupt. The person that they owed the money to goes bankrupt. The people who were giving the money to those guys to lend to the other guys go bankrupt. They lose their houses and lose their jobs and end up under a bridge with a bunch of fentanyl. Seems to be the way it goes. Whew, crazy. Recession becoming increasingly likely in 2024, according to this article here from Fortune, because companies are facing a huge shock of having to refinance that debt at higher interest rates. Fidelity International Salman Ahmed is sticking by his call for a recession, even as Wall Street ups wages at the Federal Reserve has navigated the U.S. economy towards a soft landing. Remember, Goldman Sachs now giving a 15% chance of a recession next year. They are pricing in that things are going to be okay. The end point of this cycle is recession because the transmission channel will kick in. He said in an interview, if the Fed doesn't back off at some point, everybody has to pay these higher real rates. So this is probably one of the biggest threats economically right now is this massive refinancing of all of this debt, because a lot of these guys borrowed when the money was cheap back in 2020, when interest rates were basically at 0%. That meant they could borrow money from the bank at like 1 or 1.5%, which is nothing. But when suddenly they have to refinance that and now the rate's 8%, holy cow, that is crushing interest payments. A lot of companies, because demand's already falling, people are afraid, discretionary spending. Remember, most of the companies who went bankrupt, discretionary spending. People are spending less. That means that these companies have less income. And when their biggest line item on their budget, expense-wise, becomes their interest payments, a lot of companies won't be able to keep up. We will see more bankruptcies unless the Fed starts cutting quickly. So the Fed is pretty quickly driving the entire U.S. economy towards a brick wall at 100 miles per hour. And everyone's saying, Jerome, maybe that's enough. Maybe you put on the brakes now. Slow down a little bit. And he's going, no, let's go faster. It's crazy stuff. Crazy stuff, man. Hey, before we get into the rest of this news, just a quick reminder, if you're not signed up yet to the Wealth Mastery newsletter, you got to check it out. It is the best newsletter in the cryptocurrency space. Every single issue absolutely jam-packed full of free value for you. We have altcoin alpha, altcoin news, the latest happening in the crypto markets, airdrop alpha, DeFi, technical analysis, tutorials, and more straight to your inbox 3 times per week. So check it out using the link in the description. Now, Jim Bianco points out here, these bankruptcies, they are the credit event. A lot of talk's been thrown around recently about a credit event is coming. Well, the credit event's probably already here. These bankruptcies are the credit event. So lending leads bankruptcies. Changes in lending lead to higher levels of bankruptcy filings. The rise in bankruptcies results now is the result of tightening lending standards before. So banks has tightened lender standards about a year ago. They've been tightening for a year. We're seeing those interest rates increase. So when the refinancing happens, banks are already less likely to work with people. When they say, hey, can I restructure my debt or anything? They're going to say, no, we're not doing that right now. Sorry, go bankrupt. So the credit event is already here. The economic turmoil is happening as we speak. The only question is, how bad is it and how bad will it get? As we mentioned, the amount of bankruptcy so far is not that dramatic historically comparing. We're not like at thousands of companies or something like that. Hundreds, but hundreds is pretty normal, even in great economic conditions. But the thing is, it's not just America. The EU also facing a wave of bankruptcies. So huge amounts of bankruptcies coming in the USA as well. Lots of companies in a big problem there. Of course, a lot of EU countries have already been in recession. Germany's been in a recession already. They're already in recession. A few other EU economies are in recession or dealing with huge inflation problems. Some countries still have 10 to 20% inflation issues in Europe. Consumers in Europe are getting hammered super freaking hard. And the European Union combined is the second biggest economy in the world, just ahead of China and just after the USA. Now, individually, those countries Many of them are in the top 10 economies globally. Certainly, many of them in the top 20. So very important what's happening there as well, because that affects US companies, it affects Chinese companies, that affects the global market. This chart here showing those European bankruptcies that are on the rise here. Huge tick up right across industries, where we're seeing transportation getting hit really hard. We're seeing accommodation and food service bankruptcies going up dramatically. We're seeing education and social activity bankruptcies going up dramatically. The only ones that are not seeing huge spikes in inflation, motor vehicles, information, stuff like that, more of your basic consumer goods stuff. So these are pretty shocking numbers here, guys. We are definitely seeing some real problems globally in the economy as these high interest rate, high inflation environments continue. They're putting a lot of pressure on consumers, which is putting a lot of extra pressure besides the higher interest rates and stuff like that on companies. And then here comes Russia and Saudi Arabia, man. Big oil cuts. Those big oil cuts mean one very simple thing. The price of oil is going up. The price of oil going up basically means the price of everything could go up, which means inflation could spike back up. Still high in Europe, could go higher in Europe, could spike back up in the USA as well, which creates, again, a system of more pressure. So we see a lot of headwinds here. And this is all bad for risk assets, by the way, because people are a lot less likely to ape into monkey pictures or tech stocks or whatever else when economic conditions are like this. Even people who have a bunch of money are more likely to sit on that money and wait for conditions to improve slightly. And I know we've seen huge rallies this year in the stock markets, big rallies this year in the cryptocurrency markets. But until we get some resolution to some of this, we could see people being a bit more hesitant moving forward in the markets for the rest of the year. Or not. We could just see people completely ignore all these macroeconomic factors, as we have done to an extent this year. A lot of this stuff has been coming. A lot of the stuff has been known to the markets, known to the analysts at places like Goldman Sachs that are predicting there's only a 15% chance of a recession. Companies go bankrupt. Companies go bankrupt. Who cares? Inflation goes up. Whatever. Governments will print money. Who cares? Recessions, they'll print more money. Who cares? That is certainly a bit of a contrarian take that, yeah, there's bad stuff happening in the economy, but maybe it's really not that big of a deal. Maybe we do get our soft landing from the Fed, as Will Clemente points out here. Negative news currently at an all-time high globally. Political extremism on the rise. Human Development Index has climbed 2 years in a row. If you're bullish or an optimist in this current climate, well, it's a bit of a contrarian take, to be honest. And as a final thought here, if you are feeling very, very bearish and like a new Great Depression's here or whatever it might be, just keep in mind, this is the S&P 500 over the last 20 years. There have been giant, brutal, savage recessions, huge bear markets. And if you had simply dollar cost averaged right throughout that period, for the last 23 years, if you've been dollar cost averaging into the S&P 500, you would have created massive wealth, because it's gone from being worth about $700 to around $4,500 right now. And of course, with Bitcoin, your gains would be astronomical in comparison. So I'm not betting against innovation. I'm not betting against the future of our technological revolution that we are going through. It will have crazy impact on markets, and we'll have short-term chaos because of what central banks are doing. But long-term, I remain bullish on basically everything. Life. I'm bullish on life, guys. Let me know if you're bullish on life too down below in the comments section. I'll see you next time.